In this week's video, we're just going to look at some valuations on the equity markets and also bond markets. I want to first have a look at the equity risk premium in the US. And with the sell-off in markets over the recent period, our measure of the equity risk premium based on consensus earnings expectations has pushed up to about 7%. So obviously quite a significant sell-off there, but it also puts it in line with the peaks that were seen during 2011-12 European debt crisis, and also the first move up into this vicinity in the financial crisis. So it begs the question whether value is starting to appear in the equity versus bond decision. So what we thought we might have a look at first is just some scenarios. So and remember, this is using consensus EPS assumptions in this calculation. But if we were to use a range of different assumptions, I'm going to choose a recession earnings scenario, which is basically the experience over time has been that EPS has declined typically around about 15% during recessionary periods. So if we use that as a bit of a template, obviously noting that during the financial crisis, earnings was down something like 40 to 50%, but on other occasions, typically around about 15%. So if we introduce that into the equity or the implied discount rate and the equity risk premium, it gets it back down to about 6.6. You can just see where the cursor is there. So it still leaves it pretty high, although somewhat lower than what the consensus numbers currently suggest. If we then said, okay, let's say the market declined to say around about 10% from current levels, so took it down to 2,600. This is what we get, and this is without a decline in earnings. This is just a decline in the market. So that's the dark blue line now. That has the equity risk premium sitting up around about 7.25. So in excess of those previous occasions. But of course, it's unlikely that you're going to get a 10% decline in the market without some sort of associated earnings downturn, one would imagine. So what I've done here is just introduced another scenario that says market's down 10% and earnings growth is down 15%. And so that is now the dark blue line. These keep moving around. But basically what it would suggest is that the equity risk premium would still be around about 7%, so at the peak. So I guess what we're saying is that a market down at sort of 2,500, 2,600 with bond yields at say 0.75 and earnings growth 15% below current consensus numbers would leave the equity risk premium in the US sitting at around about 7%. So whether this represents the peak in that measure is obviously a key question for investors, but certainly the risk premium is offering and actually incorporating some downside risk to earnings. Now I just wanted to quickly turn attention to a couple of comments on the bond market. Just a couple of charts here. So what we're looking at is the break-even inflation rates in the US and also in the Australian bond markets. And with the massive rally in bonds over recent days, what we saw is that the break-evens in the 5-year part of the curve, so I guess an 5-year implied inflation rate has fallen down to as low as about 0.8. It picked up a little bit just yesterday, but a serious decline from levels prior to the coronavirus of around about 1.2, 1.3. So bonds, nominal bonds pricing in incredibly low inflation over the next 5 years. And in the case of Australia, we can see a very similar result, the red line being the 5-year implied inflation expectation number coming into about roughly about 0.8 as well. So bond markets are pricing in very pessimistic outcomes over the period ahead, as you can see there.